Hey guys, Michelle Kinney here. Thanks for checking in. Thanks for checking out my video. I'm going to make a quick video today and address the comparison of a couple of different investments. So yesterday I had a quick conversation with a guy in my building. His name is Avi, and he was talking about SPY, trading SPY. Now, he was talking about trading spreads in SPY, but I want to show you guys how to choose what stock to trade and how volatility is an important factor in that, right? So SPY is an exchange traded fund, and it's got a bunch of things in it, right? So I don't really trade options on ETFs, although you could. An advantage of trading SPY is that it has like daily expirations. So today, tomorrow, the next day, etc. Whereas most regular big stocks will have weekly expirations every Friday. So that is an advantage. However, the implied volatility is very low on SPY. So on average, the implied volatility is, I'm just looking it up on my computer next to me, but it is about, let's see, hang on one second. So the implied volatility on SPY is somewhere around 13%, give or take. Now, I looked up SPY before I'm doing this video, and the biggest holding inside SPY is Nvidia. So SPY has a bunch of different things that it invests in. Nvidia is the top holding at the moment, Microsoft, Apple, Amazon, Meta. It's kind of all these like big companies. So an advantage of investing in SPY is that you do get, all of these companies inside of this one thing, right? However, if you do the mathematics on it, so SPY right now is trading at $628 per share, right? So it's kind of expensive. So let's say you were to sell a 625 put, right? A 625 put that expires Friday. The margin on that is about $9,000, a little bit more than $9,000. What that means is, you might recall that margin is kind of like what the broker-dealer requires that you put up in order to make the trade. So even though it's $625, per share, if you were to have to buy 100 shares, that's $62,000, but you only have to put up a very small amount because the broker-dealer floats you the rest. Now, you do have a little bit of risk in that because it is a $600 stock, right? So you want to keep that in mind. So if I'm calculating selling a put on SPY and it's $628 now, and if I sell a 625 put, the delta on this particular contract expiring this Friday is 30%. What that means is it's an approximate 30% likelihood that SPY is going to go down to 625 or lower before Friday, right? So it's about 30%. And the reason I'm saying that is because I want to compare like an apples to apples, give you an apples to apples comparison on one trade versus another trade. So right now the premium on that is $153. What I mean by that is you take in $153, you're committing to buy 100 shares if it drops below $625 before Friday. If it doesn't drop below $625, you don't buy the shares, but either way you keep the $153. Now you're putting up in this scenario about $9,200 in margin. So mathematically, if I'm putting up $9,200 and I'm taking in $153 and I'm holding that trade for 4 days, because today's Tuesday and I'm looking at a Friday expiration, your rate of return is about 104%. So that's not bad, right? However, me personally, I look at rates of return in excess of 200%, or at least let's say 150 or something. I mean, it's not a black and white science, and a lot of this stuff is gray, and you're gonna find your own groove. But I have found that if you are targeting excessively high rates of return, you have a lot more flexibility in being wrong, so to say, right? So you can actually end up buying the stock sometimes, and you can, gives you a little bit more flexibility. So it doesn't necessarily have to always expire worthless, right? And you can still make a lot of money because you're targeting a higher rate of return, right? So SPY, it's a $600 stock, right? Super expensive. You're making $150, right? And you're putting up $9,000. Now, I want to compare something to you. So now SPY, the biggest holding inside SPY is Nvidia. And I want to compare, forget about SPY, if you just sold a put on Nvidia. So let's talk about that for a moment, right, as a comparison. So Nvidia right now is about $171 per share, so it's much, much less expensive. What does that mean? That means your risk is a lot lower. Like, let's say the market crashed, right? as an example, and you have to buy 100 shares of SPY, you know, you're committing, even though the margin is $9,000, you know, if it goes down, that margin is going to fluctuate. You know, it can and will fluctuate. So the stock itself is a $600 stock. So you're committing $60,000, right? Whereas Nvidia is a $170 stock. You're committing $17,000. So much different, right? Significantly different. So Nvidia, I'm going to look at an apples to apples comparison. I'm going to look at a 30 delta. In other words, a 30% likelihood it's going to go from where it is now down to the strike price between now and the expiration date. So a 30% delta would be a strike price of about 167.50, right? So here, let me break that down. Right now, the price is going for 171.38 per share. I'm going to sell a 167.50 put that expires this Friday. So same thing, 4 days away. The premium on that is $113 right now. The market's not yet open, but that's where it closed yesterday. So $113. You're taking in $113. You're committing to buy 100 shares at $167.50 if it goes to that price or lower before Friday. The margin on this particular trade is about $3,100. So you're putting up a third less than SPY. And your rate of return, if I calculate that mathematically, I'm taking in $113, I'm putting up $3,100, I'm holding it for 4 days. My annualized rate of return is 225%. In my view, I'm not giving you a recommendation, I'm not a financial advisor. However, in my view, it's a far better trade than trading SPY, right? It's a $170 stock versus a $600 stock. And why is this happening? A couple of reasons. Number one, the volatility on Nvidia is much better. So the volatility on Nvidia is, let's see, that is about 36%. So it's not super high. So here's what implied volatility is. Implied volatility is kind of like the swing that it does, right? So the more volatile a stock is, the more you get paid in premium as an option seller. But that kind of cuts both ways because you get paid more premium, however, your risk is generally a little bit higher. So like, let's say, as an example, if I look at the volatility of MicroStrategy, for example, that's one of my favorite stocks for a very, very long time now. The volatility is like 73%. So the higher the volatility, the more premium that you're getting, but your risk is a little bit higher as well. What does that mean by risk? It means you're gonna have more swing. This is the way I look at volatility though. Especially when you kind of get the sense of trading something over an extended period of time. MicroStrategy and all stocks in general will go like this, right? It's kind of like this sort of roller coaster ride, and that's okay. And so my view on that is let me sell a MicroStrategy. Let me look up the MicroStrategy numbers. Just wait one moment. Okay, so the MicroStrategy numbers are this. MicroStrategy right now is trading about $426 per share. If I'm going to look at the same 30 delta, right, that would be a strike price of $417.50. So what am I doing? I'm saying I'm committing to buy 100 shares at $417.50 if it drops to $417.50 or lower. The premium on that right now is $602. So the premium is much higher. Now the implied volatility on MicroStrategy is 73%, as I said a moment ago. So that's, it's going to have a lot more swing. So your premium is a bit higher, right? And your capital required on this particular stock. So you don't, oftentimes you don't get as much margin on a more volatile stock from the broker dealer because the broker dealer is saying, okay, there's a little bit more risk, right? When it swings a lot. So your margin on a percentage basis would be a little bit higher in MicroStrategy than Nvidia, generally speaking. So your margin on this particular trade might be, let's say, $15,000. Mathematically, if I'm putting up $15,000, I'm taking in $600, I'm holding it for 4 days, your rate of return is 259%. So your rate of return is a little bit higher on an annualized basis than Nvidia. And here's how I look at things like this, right? I look at it like, okay, MicroStrategy is a strong company, right? Michael Saylor, the CEO of MicroStrategy, is super, super smart. He borrows money and buys Bitcoin, and Bitcoin is like, Bitcoin's like this, but over the long term, Bitcoin is very high. I'm a big believer in Bitcoin and cryptocurrency in general. And I feel comfortable, and here's where it comes out down to like margin and holding capability. But so you have to make sure your margin is in check. I'm going to talk about that in another video and in a moment as well. But what I'm trying to say is that if I do have to buy MicroStrategy, let's say if I buy, or rather I sell a put on MicroStrategy and it drops below my price and then I sell a put, I'm very comfortable in selling a covered call against that stock, those 100 shares on Monday. And generally speaking, those calls are going for, $500, $600, $700 at the money. So here's how I look at it. I'm taking in $500, $600 when I sell the put, sometimes upwards of $1,000, depending on the volatility, depending on, how that swing is during that particular time frame. But generally speaking, over in excess of $500, right? I'm selling a put, I'm taking in $500. If it drops down and I buy the shares, it's okay. It's a great stock. It's not going to go bankrupt, I don't think. And then I'm going to sell a call against it and make another $500. So I'm making money on both sides. So here's what I'm doing, guys. I'm trying to set things up where I make money regardless of whether it goes up or down or stays sideways. So obviously, is there risk? Yeah, there's going to be risk. It's important to keep your margin in check. So here's the thing, guys. A couple points that I want to make. How am I calculating my rate of return? Right now I'm using the app that I created. So I do have a spreadsheet, and if you put a comment in the comment section here on this video, I'm happy to share that spreadsheet. It's just a mathematical equation. Okay, how much am I taking in? How much am I putting up in capital to make the trade? How many days am I holding that? What's my annualized percentage rate of return? So there's an old school, spreadsheet where you type those in, and that's what I've used for a long time. I've created an API that fetches that data. So in other words, I can put in, okay, I just want to look at MicroStrategy, and I want to look at, let's say, a 30 delta, or I want to look at this particular strike, and it fetches the price and calculates it automatically for me. So that is a lot easier to do, right? So that's what I'm using right now, on my laptop. Behind my phone that I'm talking to you on, to calculate the rates of return. I don't ever put a trade in without calculating the rate of return, because I want to know how much my return is. What am I getting for the risk that I'm taking, right? If you don't do that, it's kind of like you're just trading blindly. And I don't think that that's smart. So I don't ever put a trade in without calculating the rate of return. So keep that in mind. And number two, and this is probably even more important than that, I don't ever use margin without clearly understanding, okay, if I'm trading MicroStrategy and I'm putting up, let's say, 15,000 in margin, I want to know at which point does MicroStrategy have to go down in order to trigger a margin call, right? When you're using margin, it's very important to pay attention to these types of scenarios, like hypothetical, okay, if MicroStrategy goes down X percent, if Tesla goes down X percent, if Nvidia goes down X percent, will that trigger a margin call? Why is that important? Here's why that's important, guys. I am always focusing on realized gains, right? I don't really care that much about unrealized gains or paper gains, paper losses, because that's not cash in my pocket. I care about realized gains and realized losses because that affects the cash in my pocket, right? Now, if I'm using margin and I'm borrowing money from the broker-dealer will adjust your margin based on volatility in the marketplace. Meaning, and I'll just break it down simply, let's say we have a significant decline in the market, like a bear market coming. You could be okay using your margin now and you have some breathing, some leeway, whereas if the market dips or if your underlying trades dip, it won't produce a margin call. However, let's say, there's a 20% decline coming and it's a quick decline and a significant decline. You want to know if a margin call will be affected from that, because a margin call says that you either have to put more money in or you have to break a trade. And here's why that's important. If you don't have money elsewhere that you can infuse back into your account to tide you over during that downtime, you have to break a trade or buy back your positions, liquidate your positions. And that will create and cause you to turning a paper loss into a realized loss. So that's super important. So two super important things that I've been working on I always had these spreadsheets that kind of calculate that, but working on these APIs to automatically feed that data is rate of return, how much money am I making for the risk that I'm taking, and where's my risk? Where is my account going to get blown up? Where is a margin call going to be triggered? So that's super important. If you want to know more and if you want calculations or access, I'm going to be rolling out these tools soon to the public. I have some beta sets going. In other words, like free for a certain period of time to individuals that are trading that are going to be using these tools, that you can give me some feedback on a user basis. So if you want access to that, please drop a comment below. That's super, super important. And anyway, I hope this helps. So happy trading. Subscribe to my channel. Put a comment in the section here if you want to know more. And have a great day, everybody. See ya.